I'm going to go over what's a bond. A bond is basically you're giving a loan to the government or to a business. If it's to the government, it's usually the treasury if it's at the federal level, or it's a local or municipal bond, which is effectively how you raise money to build certain things. A business might also say, I want to make something, but I don't have the money and I don't want to go get it from the bank, so the business might go and get a bond and have bondholders. So you are a potential bondholder. Say the face value of the bond, what it will be worth in a year, 10 years, 30 years, whatever that may be. Let's just use that as $100 just for easy math. Let's say today there's a 5% return on the bond. That means today's price, if I bought it, is $95. Now, what if the interest rates are going up like they were in 2023? If the interest rate goes up all of a sudden, and let's say it goes up to 10%. What happens is, in order for me to make 10% of my money and sell it at $100 when it's due at the end of its lifetime, effectively the bond value will be close to $90. This is why people were worried with the banks in 2023 and why some of the banks started to fail. Because they bought bonds from the federal government at, say, 99 cents on the dollar. When the interest rate went up to about 5% or so, all their bond values decreased. So if there was a run on the bank and people pulled the money out and they went to sell the bonds, they would get less money from the bonds than what they are owing the customers, which would then bankrupt the bank. Just understand, if interest rates are going up, the bond value is going down. If the opposite, if the interest rate is going down, the bond value goes up. So if the Fed sees that our economy is slowing, they're going to start reducing the interest rate to try to stimulate growth. And when they do that, which I don't know if it's going to be in this time, when they reduce that interest rate, I'm just going to pick a number, let's say it's 2%, that bond value has to go back up because you're only going to get 2% and you're still going to go to the same face value. When interest rates go down, bond values go up. I don't like to invest in bonds or bond funds when there are rising interest rates, but I do like to invest in bonds and bond funds when the interest rates are going down, because you have a dramatic increase in the value of the bond. There are some tax benefits if you have municipal bonds and things like that in terms of not needing to pay some taxes. And if you do all of this in tax advantage accounts such as 401ks, IRAs, 403bs, things like that, you don't pay taxes when the money's made. So if you're looking to make more money and just understand finance a little bit better, subscribe.